Hi everyone, Jason Burak. I just want to do a quick video, Wall Street for Main Street investing video, investor alert, let you guys know what I see going on in the markets right now. We're always looking for very good long-term investing opportunities where we can take cash on the sidelines and put it to work long-term, where the companies are sound, they have good balance sheets, generating free cash flow, the market is wrong about something, and I think this is an opportunity that I want to talk about. I mentioned in other interviews and videos I've done in the past briefly about oil. I want to go more in depth about the oil market and show you some examples of profitable companies that I see in the oil market right now. Oil is also an inflation hedge. It's black gold. It's consumed. It's gone. So once it's used, it's not really recyclable. Although in the lab, if oil was $200 or $250 or $300 a barrel, maybe they can make hydrocarbons work economically. But right now there are a lot of profitable oil companies in just the last couple weeks that have gotten slashed, 20%, 30%, some of them even 40% discounts to what they were even a couple weeks ago, all because the oil prices come down, which I think that's financial warfare, why the oil prices come down more so than supply and demand, where global demand for oil has not really dropped. And I think I've laid that out the case for the BP statistical review. You can look up other research there for supply and demand. Obviously do your own due diligence for this, but I just want to give you some examples of some profitable oil companies, how profitable they are despite the oil price dropping, and some of the amazing potential dividend yields that are available. And there's dividend yields, guys, that are available in profitable oil companies, whether they're in Canada, in the US, or all over the globe, from 2% to 8%, and these companies have very solid balance sheets, not a humongous amount of debt, very solid free cash flow, very good earnings. Some of the companies, if they're deep water offshore drillers, so a company I wanted to, there's Transocean, which is symbol RIG on the New York Stock Exchange, or Diamond Offshore, or Pacific Drilling. Or if you want to take a little bit more risk, there's Ocean Rig, but that's owned by Dry Ships, and that's more of a turnaround story. But an interesting play I wanted to profile is called Seadrill, which is SDRL, or Sally, David, Rachel, Lisa, on the New York Stock Exchange. And Seadrill is a deep water offshore drilling company. They own a whole bunch of high technology, new age rigs. And they order in the industry. They're one of the largest companies in the industry. They're owned by, I believe, a Norwegian billionaire. And their earnings per share is over $8 earnings per share. Their PE ratio is now below 3, and their dividend yield is now at 17% dividend yield. So this is a pretty good risk-reward play here. Obviously, don't put all your money in Seadrill. Not telling you to do that. There's going to be gamblers out there that are not going to listen to what I say, but I think this is a really good time here to put some money to work that you had on the sidelines. And like I said, oil is a good inflation hedge. Over the long term, there's going to be more people in the middle class in China, in India, in Africa, in the Middle East, in South America, who are going to be buying their first motor scooter, or pooling their resources with their family that they've saved up, or their village, and going to buy their first car. And they're going to want to consume oil. And once they bought, that motor scooter or that motorcycle or that car, they're not going to want to stop consuming oil. So it's more price inelastic than many people think. Although here in the developed world, I would say oil prices are more elastic in price than in the developing world, because people want more of a developed world lifestyle in the developing world. They want to have electricity, they want to have higher calorie diets in their food, they want to drive a car or things like that, rather than walk somewhere all the time, or a bicycle, especially if the weather is bad. So Seadrill there offers, maybe the dividend yield on Seadrill will be cut. They do have some debt, but for pros for Seadrill, they have a really long-term order book. So their order book for national oil companies, whether that's in Russia or in Saudi Arabia or in Brazil, they have a lot of large oil companies who have their rigs booked, out for years. And maybe these oil companies will cut back on exploration expenses or drilling expenses, but it's not going to be a massive cutback necessarily to zero. I mean, these oil companies know that these large oil producers know that in order to continue to produce profits, they have to keep figuring out ways to find more oil. So it's a really interesting time right now. A lot of the oil producers are pricing in, oil going to 60 or 65 or lower. The shale oil companies can't really survive, most of them at that price, because their balance sheets are a lot of them have really leveraged balance sheets compared to the rest of the oil industry. And their debt has actually grown faster than revenues and also faster than free cash flow and then earnings. So the shale oil producers, like some of them are hedged, obviously. So for a couple years, maybe the shale oil producers could, some of them, deal with lower oil prices, but it's not sustainable over the long term. So if you do your research and your homework here, or you hire Mo Dawood, John Manfreda, and myself to teach you how to find these opportunities, you can go in there and find companies like Seadrill that are profitable, that have really outstanding dividend yields, and you're getting paid to wait, and you might get some capital gains to boot there. And maybe, if the oil price goes back up, they can, on their order book there, because their rigs are booked solid for the next 10 years, they can increase the price on those, charge a higher day lease rate, and the lease rate is already fairly high. So pricing power for a business is important. The oil service companies, so, your Schlumbergers, your Halliburtons, your Baker Hugheses, your Weatherfords, those types of companies are still in a bull market, in my opinion. And I think, in terms of valuations, there's just really great valuations across the board in the oil patch. And, unlike a lot of the miners, I'm not talking about the royalty and streaming companies, but unlike, a copper miner or gold miner, these oil and natural gas producers consistently generate free cash flow a lot faster. They can be in production a lot faster, and the oil service companies get paid before the producers. It doesn't matter if the oil producers don't hit a dry hole or something like that. So the drillers and the oil service companies are still, putting in pipelines and things like that. And there's just a lot of opportunity for yield here. It's much better than bonds. I'd much rather own a company like Seadrill or a number of MLPs like Kinder Morgan or Martin Midstream Partners or Vanguard Natural Resources or Brightburn Energy or Lynn Energy or things like that than, own a government bond or, a highly levered institutional bond or something like that. I think these are a lot better than bonds because I think oil is a very solid inflation hedge. And over the long term, it's black gold. The petrodollar was created because trading oil for gold. And the Saudis wanted to trade their oil for gold, and the U.S. didn't want the paper price for gold to go much higher, so they instituted the COMEX and other things like that with the petrodollar. So I think oil is a good long-term inflation hedge. In the short term, it might go lower, but this is an opportunity to put money to work safely over the long term and get some really great bargains across the board in the oil market. So definitely check out Seadrill, do your own due diligence. There's a lot of other opportunities in the oil sector. If you want help with the oil sector, how to research it, you want us to break down, Wall Street for Main Street, to break down the oil sector for you, tell you everything you need to know about the oil sector and how to make money in it, we offer consulting work. So paid consulting, investor education, and consulting work. So thank you for your time. Definitely look into oil for yield in your portfolio. It's probably the most undervalued free cash flow generating, yield paying opportunity in the whole entire stock market right now, in terms of, like I said, free cash flow and yield. So and very solid balance sheets for a lot of companies. I mean, there's dozens of really good Canadian energy stocks too that are paying between 4 and 8% dividend yields too that are very profitable. So thanks again for your time. And I'm just recovering from my surgery right now. I guess my voice feels a little bit better enough to do this video. But, we'll just start with the interview schedule again next week, and we'll go from there as Wall Street for Main Street marches on to 500,000 views on our YouTube channel and farther. And, we're going to work on getting the website back up. We're going to start doing due diligence on the WordPress developers this week and next week, and hopefully we'll hire someone soon to get the website back up. And, then we could start raising capital again. Our Indiegogo page is just about done. So if you guys want to give us some money to really build this thing out, I think we're going to have probably the top investing podcast here on YouTube and or iTunes in the next couple years, or if not the top one, of the top 5 or top 2. So just let us know if you like this, and definitely look for oil for yield. There's value across the board, and these are not speculative plays. These are very profitable companies, as I demonstrated with Seadrill, and I can name you dozens of more examples of profitable plays that the market just indiscriminately chopped 20% or more off the board, and I don't think it's deserved. But in the long term, it's an opportunity, and you want to be one of those long-term investors, those contrarian value investors that is willing to buy when other people are selling in this case. And it's not like these companies are not profitable. These companies are profitable. So, you know, one of the things about stocks is that people do not buy stocks when they go on sale. You know, people buy vacations, people buy groceries when they're on sale, people buy vacations when they're on sale, people buy electronics, TVs, things like that when they go on sale. People buy, you know, Groupon specials or living social deals, even if they had no intention of trying them, they just compulsively buy them. But people, you know, rationally, objectively, cool, calm, without emotion, most people will not look and research and buy a profitable stock that's on sale. They think, oh, the chart must be right, or something's wrong that we don't know about, or something like that. So, you know, if you want to make a lot of money in the market, you want to do well for yourself and your family and generate dividends and things like that, this is how you make them over the long term. In the short term, you know, maybe oil does go down a little bit further because the chart's bad or things like that. But I think I've laid out the supply-demand fundamental case for why oil prices should start going higher again over the long term. I mean, I'm not expecting an oil spike anytime soon, but, you know, over gradually going higher over the long term. In the next couple years, and why, you know, you're going to get paid to wait with these profitable oil companies that are you know, the oil service companies that are doing pipeline work or fracking or hauling water, things like that, to the shale oil plays in the Bakken in North Dakota, or the Eagle Ford in Texas, or the Permian, the new Permian player, some of the other higher cost plays. These guys are in a bull market clearly. So thanks again for your time, and talk again soon, guys.